This is James Eng of Old Capital, and today we're going to be talking about sort of economic update for March 2022 and sort of how that is impacting multifamily in terms of financing and investing. So here is how I'm thinking about the world. I think right now, since our last update, Russia has invaded Ukraine. We've had the first Fed increase in about 4 years. And so, as you think about this, we're going to walk through some slides around the impacts that the war has had on the supply chain, how that is only going to increase inflation, and then that is going to drive the Fed to continually increase interest rates on the front end of the curve, which they have control over, whereas the market has control over the back end of the curve, the 10-year treasury, and how that is going to put pressure on the yield curve, which has in the past led to the R word or recession. So let's jump in here. And so we're going to talk about economic update, multifamily update, and then we're going to talk about sort of the different ways that people are financing deals right now in terms of non-recourse bridge, recourse, and then also Fannie and Freddie. So let's jump in here. So my background has been born and raised in Houston, went to school in Austin. I've lived in DFW since 2006 and started on the underwriting side of the business. And then now on the origination side for multifamily loans with Old Capital, and then investing in properties throughout DFW and Austin right now. All right. So in terms of where we're looking in terms of the market, in terms of jobs right now, I mean, it's essentially back. I mean, a lot of times it takes the Great Recession, it took a while for us to recover all the jobs back but from COVID, I mean, we're essentially 2.5 years in, and we're pretty much back to where we were. The challenge right now is really having enough people to fill those jobs. So that is the bigger challenge versus people wanting to work but there being no job. So plenty of jobs right now. The bigger challenge is the inflation. So inflation, whether it's used cars, whether it's gas, whether it's food, everything seems to be going up in pricing right now. And the war is also going to impact oil pricing in terms of wheat pricing, a lot of things that go into all the day-to-day stuff that you're buying. So we've seen multiple inflation readings the last 2 months at anywhere from 7-8%. On an annual basis. And so that's sort of inflation levels that we haven't seen in a very long time. I mean, going back, I think this is probably sort of mid 2000s, and then sort of in the 80s, you saw inflation this high. So I think most people are seeing this inflation number to be in the 7, 10, 12% range over the next couple months until this is until that eases. And so, a lot of the Fed's mandate is keeping inflation around 2%. So they did a really good job of keeping it around 2% here for the last, 5, 6, 7, 10 years. And then now they're putting a lot of pressure on inflation. And so they're going to have to do something. And so they have raised the SOFR rate, or the federal funds rate, by 25 basis points, which impacts your SOFR rate, which is what you borrow against as a multifamily investor. And so we're starting at 25 basis points. And then these little plots are sort of where the different federal governors are projecting where you're going to end up. So this is January 2023, which is, less than a year from now. And they're pretty much the median of all of the estimates is right at 2%. So can you imagine going from 25 basis point to 2% in less than a year? So that is where they're projecting. And then, they sort of top out at 2.5% here and then start coming back down. And so it's actually pretty interesting. This seems to be the track that they've done in the past. And so we'll look at sort of history to try to predict the future here. So if you have, let's say, a floating rate loan right now, and it's, let's say, 3% over SOFR, your rate could go from 3.25 all the way up to 5% within the year. So, all right, so let's look at historically what has happened. So this comes from Pensford. Basically, if you look at they've essentially, when they've increased rates, it seems to have been on average about 2.2 years. and it's never exceeded 3 years. So if we're sitting here in 2022, it has not exceeded 3 years on the rate hikes. It looks like they hiked their rate from 2005 pretty much all the way to 2007. So that was the longest time frame. This last time, 2017 to 2020, it was about 2.5 years. So you could see rate hikes for the next about 2 years, 2.5 years, and that takes us to hopefully around 2% on the federal funds rate. 2.5% is where they're projecting. So at some point, they basically hike until they lead us into the next recession or cool down. So this is where people are getting a little bit more nervous, is if the difference between the 10-year and the 2-year treasury, right? So you typically want to see a yield curve that is sort of up and to the right. You usually want to see this at, let's say, 1.5%, the 2-year, and then 10-year, let's say 2.5%. You want to see a good spread between those two. But right now, this is sort of a snapshot as of today. 10 years at, let's say, 225, 230. The 5-year and 7-year are already higher. And then the 2-year, there's going to be a lot more pressure. The 2-year treasury has probably jumped, 100, 150 basis points this year already. So that 2-year treasury is impacted a lot more by the federal funds rate. And so when you're seeing this 10-year minus the 2-year hit 0 or underneath 0, that's an inverted yield curve. And so that has not necessarily led to the recession, but predicted the recession. And so here's another chart for Pinsford. Essentially, once the inverted yield curve has happened, then it's predicted a recession, or the recession has occurred, typically on average about 1.7 years. And so if, let's say, there's an inverted yield curve today, on average, a year and a half from now, we'll be in a recession from a GDP standpoint. And so the average is probably a little bit off because of COVID here. But if you look at the last three, so 2008, 2000, 2001, and in 1990s, this was, on average, probably about in that 1.5 to 2 year range. And so it's just sort of looking at the past to figure out the future here, and looking at the inverted yield curve. So the more pressure that the Fed puts on the front end of the curve, then the faster this is going to happen. All right, so this is, obviously it's nobody wants any good news to come out of a war, but sort of with Russia impacting or invading the Ukraine, it's been a couple of benefits that was noted in this article about how the U.S. benefits. So, the U.S. actually doesn't trade. It seems like if you look at sort of this third item, Russia doesn't really trade with the U.S. a ton compared to how much the European Union trades with Russia. So I think a lot of the stuff that let's say the European Union was going to buy from Russia, they're going to buy from the U.S. now. And so whether that's natural gas, whether that's oil, whether that's weapons, like this cartoon illustrates here, is that all of that stuff is going to come from the U.S. now versus Russia. So U.S. is going to benefit. And then, I was listening to a webinar with Neil Bawa, and he was talking about how, if you're going to pick a place of what's going to benefit, like let's say what state is going to benefit from this war, it would lead you to a couple of states, one of them being Texas. And Texas benefiting from higher oil pricing, higher natural gas pricing, and then also from just sort of the defense spending that's going to happen as well. So, it's tough. You don't want to benefit from war, but we weren't part of it, and they invaded Ukraine on their own. So, that's going to be one of the benefits. So let's flip over. So that's sort of what's happening sort of in the world economically, impacting you as a multifamily investor. But let's look at some of the multifamily data that's out there. And a lot of this data came out sort of in wrapping up the year 2021. I pulled out some data. This comes out of Newmark. They talked about lease trade outs, and this is really what every new listing they talk about is lease trade outs. And so, whether it's in Florida, getting 30% lease trade outs. So that's, the guy leaving his unit and now the new guy taking the new lease that's coming in, on average 16%, which is a huge number. But then, Florida, a lot of places in South Florida getting 30% lease trade outs, Phoenix 30%. Your Texas markets, Austin probably is this highest, probably 20%. Dallas, 17, 18%. And that's what we're seeing across these deals is these huge lease trade outs. I mean, you can't change everybody's leases, but you're trading out 8% of the rent roll every month to these new leases. And so this is sort of organic. It's not really, you're not really doing any renovations. So you might do renovations and get another 100, 150 on top of that in terms of lease trade outs. So I had shown this slide before, but I guess I didn't even recognize this. So in all of 2020, there was 146 million or 446 billion, sorry, 146 billion of sales, all of 2020. And in the fourth quarter, there was 149 billion in sales in multifamily. So just a ridiculous number. I would say that that's probably a lot of portfolios in that number, but still a huge number for multifamily. And that just shows the liquidity. And I know there was another slide that was probably showed of all commercial properties, multifamily is probably 45% of all sales. So a huge number. And that's, with the demand of the number of people wanting to buy multifamily, the pricing is going up. And so we're just seeing a huge, on average in the across the US, about 238,000 a door. And then in your major markets, say like your Boston, Chicago, LA, New York, we're seeing about 350 a door in terms of price per unit, just to give you a perspective on that. And then cap rates seem to have defied, seems like they just keep going down. But this sort of just shows year over year, sort of where things started in 2021 and where they're, or sorry, 2020, and then where they ended up in 2021 at the end of the year. And I would say we're seeing, I'm not saying they continue to go down, but with everybody in the threes as a market, we're seeing a little bit of pressure here in terms of these flattening out. So Austin at 3.3, Dallas, Houston 3.4, 3.5, and then San Antonio at 3.9. So still relatively low cap rates across the board. And so there's going to be some pressure, I would say, if your debt pricing, what you're paying for interest rates are on top of this or above it. So all right, so these are sort of your options out there in terms of debt financing right now. At the bottom, I put sort of what we're seeing rates at in terms of bank loans, Freddie Mac, SBL, conventional, and then non-recourse bridge. And you can see that, I mean, pretty much all the pricing is, high threes, low fours, pretty much across the board, unless you do maybe a lower leverage Fannie Freddie floater, then your starting rate could still be sort of low threes or even high twos on a Fannie Freddie floater. But we're going to talk about non-recourse bridge to kick it off here. That seems to be, 75% of our acquisition business is non-recourse bridge. And so, what we're seeing right now is a lot of non-recourse bridge lenders are, not really quoting anything under 10 million. Most of them want 20 million or higher. We're seeing them increase their spreads. So 350 to 400 over SOFR is typical. And then now you as a borrower, you have to price in these rate increases. So it seemed like everybody was, pretty casually putting in maybe 25 to 50 basis points increase per year in their pro forma. So they might start at 325, 350, and then end up at 425. But now, I mean, just looking at this forward curve, I mean, in the next year, if SOFR is going to go to 1.5%, 2%, you have to forecast that in your pro forma in terms of rate increases for your debt. The number of bridge lenders we're seeing in the market is pretty constant from the last, let's say, 6 months or so. I would say that some of these lenders are having a little bit, they're having to give investors a little bit higher spread on their securitizations, and that's increasing their spread as a lender in order to make sure they make money on these deals. And then also, if these lenders can't go out and securitize the deals into the market, then they're going to be more conservative. And so we're seeing leverage come down. Last year we really saw a lot of 80% leverage, 80% of purchase, 100% of rehab. Beginning of this year, Q1, we're really seeing more 70, 75% leverage on these deals. Whether that's lenders being more conservative or just the investors who are buying the CLOs being a little bit more conservative on their leverage. I think I've shown you this chart before, but I mean, this gray section is really the CLO market. And you can see in 2020, it was pretty much non-existent. Fannie and Freddie were doing most of the business. And in 2021, it's basically been all bridge in 2021. And I would say in Q1, this trend has continued. It's been non-recourse bridge, consistently winning on these deals. I would say, when we talk to Fannie and Freddie, most of their business right now is refinancing. So they're refinancing the bridge guys out of their deals and going into Fannie or Freddie. And some of those are, either locking in fixed rate long-term debt or floating rate debt. But we're seeing pressure on the spreads. So this is the CLO market, and the spreads that are required from sort of the B piece, and that B piece is getting more expensive. And so that's why you're seeing spreads increase on the bridge market. All right, so non-recourse bridge, they're going to price over SOFR. They're really looking at going in debt yield and exit yield. So your year 3 debt yield, all in rates to start, 375 to 425. But if you're under 10 million, you're probably going to be in the fours easily, 415 to 450 all in rate to start. When we're looking at these deals, a lot of people are saying, why don't you go Fannie or Freddie? The problem is that Fannie and Freddie are still sort of stuck on their 125 debt service coverage. And so they have not changed that. And so they are pretty much pretty far away on leverage. I mean, anywhere from 45 to 50 or 55% on average. So in $30 million deal, they're at 15 million. Non-recourse bridge, I used to have this at 80. Now they're probably 75% on most of these deals, and 3.5 to 4 starting rate. So these are some of the items that you'll need on a bridge loan. Main thing being sort of your CapEx budget, your pro forma, and then also the track record of the sponsor as they dig into these deals. So here's an example of a deal that we closed, Sunset Heights in Fort Worth. We did 80% loan to cost on a 3+1+1, and then SOFR plus 400. So as you get higher in your deals in terms of loan amount, then like this was under $10 million. So we saw pricing, about 400 basis points. But if you're, let's say north of 10 million or even north of 20 million, that's where there's more lenders and thus more competition on your deals. All right, so this is probably the biggest thing that's been moving around with these changing rates is not only do you have to forecast it in your pro forma in terms of debt costs, but then also to close, you have to buy an interest rate cap. So most of these lenders are requiring at least a 2-year cap. So this was a 2-year cap bought this month, and it goes out till April 2024. And the strike, which is your cap that you're capping SOFR at, was 175. And so that on a $24 million deal was $300,000. And so when you're looking at these deals, you have to bring that to the table, right? So you have 1% prepay or 0.5% prepay, but your interest rate cap, you have to pay for at close. When we were sitting here, let's say last summer, 2021, let's say this was a $75,000 cap. And then December, it went to 150, and now it's closer to $400,000. So this is an example of how much a cap has essentially tripled from where it was. So, this same cap at 24 million, probably 6 months ago was probably 100,000. And so the price of these caps are going up. And then another thing to consider is even if you are done with your cap, or let's say you close your cap, you close your deal 6 months ago or a year ago, some lenders are requiring you to escrow for your interest rate cap. And so you might be getting a call saying, hey, your interest rate cap expectation is higher. So your escrow, similar to taxes and insurance, your escrow is going to go up as well. So be prepared for that. So some people, because of this interest rate cap pricing, because of legal costs, because of just the overall, especially under 10 million, the pricing on these deals have gone out significantly. People are sort of going back to sort of 2013, 2014, 2015 days where these smaller deals were done on bank loans. And so we're seeing people come back to, all right, can I just get a fixed rate at 375, 4.5 rate? And so we're doing actually a lot more bank loans nowadays. And so the beauty is, yes, you do have to sign, but you don't need an interest rate cap because you have fixed rate loan. So the bank is essentially using their deposits to lend you the money. And so they're not requiring an interest rate cap, and they don't have to go out and securitize these deals. So you get a fixed interest rate. You can typically close faster. So 30 to 45 days, IO for 1 to 2 years. Your amortization is shorter, right? So you're probably going to have 25, 30-year am. Low legal fees and closing costs, and then you have a step down prepay. So here's a deal we did out in Denton, acquisition, 97 units. It was 95% occupied full. So it was pretty much full, but it needed, interior upgrades to really bring the rents up. We got fixed rate at 365 on a 5-year term, 2 years IO, and 25-year AM with a step down prepay. So that actually worked out pretty well because it was under 10 million. So instead of all these costs for legal, all these costs for an interest rate cap, you were able to keep your closing costs pretty minimal on this deal. All right, so we went through non-recourse bridge, went through the bank loan, recourse bank loans. Let's talk about Fannie and Freddie now. So Fannie Mae, essentially, with the 10-year treasury going up, let's see if we have a 10-year treasury chart. Yeah, so 10-year treasury chart essentially going to 225 the last time we checked, which is a huge increase. I mean, from the beginning of the year, sitting at 1.5, now it's 225. It's a big increase, which is driven your loan rate. Typically, your loan rate is anywhere from 200 to 225 basis points over your 10-year treasury. And so your interest rates now are 425 to 4.5 on a lot of these deals. And so that is constraining your LTV. Like on this deal, your LTV was essentially 45% based on a 125. And so that's putting a lot of pressure to get these deals done. It's a lot of equity to bring to the table on that large of a deal. And so that's why you're seeing on acquisitions, a lot of people going with bridge loans. This was a deal, 60% LTV that we did, floating SOFR plus 254, which is still an option, but you do have to bring a significant amount of equity to close these loans on Fannie Mae right now. Freddie Mac, similar story. I would say, this was a deal that we had a 1031 where they had the amount of equity needed and could do a 60% LTV. This one, again, was a floating rate. So over SOFR, 3 years IO, 10-year term, 1 year, 1% prepay on this deal. So if you have a larger down payment and you just want to either put long-term debt on it, so you don't have to worry about a bridge loan, then Fannie and Freddie are probably your best options. And then this last one, Freddie Mac SBL, we've seen they move not as fast as Fannie Mae, but pretty much they've 10-year treasuries at 225, 230, and they are having to go. So you're seeing rates anywhere from, let's say, 425 on the 5-year all the way up to 460, 470 on the 10-year for Freddie Mac SBL. And this was a deal that at the pricing and the collections kept going up on this deal, so we were able to get 74% LTV on a 7-year term with 2 years IO, and this was sort of mid threes. So this was end of last year that we were able to do this sort of before the run up in the 10-year treasury. These were some of the deals that we closed in the last year or so. So I mean, you can see a lot of the acquisitions were non-recourse bridge, and then some Fannie and Freddie mixed in there all across last year. So Old Capital, we're gonna really go out there and shop the deal, whether it's Fannie, Freddie, bridge, to make sure you get the best loan on your deal. And so we help you sort of before the deal, whether it's educational stuff, whether it's walking the deal, whether it's helping you win these deals, and then representing you through the entire transaction, and then also helping you post, whether it's asset management, loan servicing, any of those things that you need. And then we charge 1% at close on these loans. If you need help with anything, well, first off, if you like what you hear, definitely subscribe and like this video. That helps help more people find this channel. And then, if you need help with a loan term sheet, definitely send me T12 rent roll OM and the whisper price, and I can get you a term sheet. Need help reviewing a deal, you can send me the package. And then really starting out, there's not going to be, we're going to review your personal financial statement and then really talk about sort of your portfolio and then what you want to do. And then if you're interested in joining Old Capital, definitely send me an email with your resume as well. So appreciate everybody watching, and I'll talk to you next time.